JPMorgan insiders' dire warning: there is no free-floating silver left. Have you ever seen a ghost in the machine? A moment where the numbers on the screen defy all logic, leaving seasoned traders and analysts speechless. That is precisely what happened in the silver market while most of us were sound asleep. In the dead of night at approximately 3 in the morning, the price of silver, which had been majestically trading above $53, simply vanished. It reappeared moments later, dramatically lower, having shed a significant portion of its value. What's truly unsettling is that this was not a crash driven by panic selling. The data shows virtually no trading volume accompanied the fall. It was as if a phantom hand reached into the global financial system and rewrote the price. This single, inexplicable event could be the most important signal the market has given us in decades. A signal that the foundational structure of the precious metals market is beginning to fracture under immense and unprecedented pressure. To fully grasp the magnitude of that ghostly price drop, we must first understand the battlefield on which it occurred. The silver market of late 2025 is not a calm sea of commerce. It is a raging tempest. For months, a titanic struggle has been underway between two opposing forces: the overwhelming demand for physical silver and the vast, complex world of paper derivatives that are supposed to represent it. On one side, you have unrelenting industrial demand, driven by the green energy revolution and technological expansion that see silver as an irreplaceable component. Alongside this is a historic surge in investment, demand from individuals and institutions seeking a safe harbor from economic uncertainty. This demand is for real, tangible metal bars and coins you can hold in your hand. This immense physical demand has been pushing prices to decade highs, consistently holding above the critical $50 threshold, a level that has historically been a ceiling but has now become a floor. On the other side of this conflict are the paper markets, primarily the futures exchanges and the exchange-traded funds, or ETFs. For years, these markets have dictated the price of silver. They operate on leverage, with the amount of paper claims for silver vastly outnumbering the actual physical metal available for delivery. This system has long been criticized for enabling price suppression, as large financial institutions could create massive paper short positions to drive down prices, regardless of physical demand. However, this delicate balancing act can only work as long as the majority of participants are content with paper claims and do not demand physical settlement. The current market is severely testing that premise. With physical stockpiles dwindling and demand soaring, the paper market is under existential threat, and the pressure on those holding massive short positions has become almost unbearable. Into this cauldron of market tension stepped the iShares Silver Trust, the largest silver ETF in the world, commonly known by its ticker SLV. In a move that rippled through the financial world, the trust announced the creation of 11 million new shares. This is not just a trivial adjustment. It represents an injection of roughly 311 metric tons, or nearly 10 million ounces, of silver into their holdings. The official rationale for such a move is to satisfy demand from institutional investors and to increase the number of shares available for borrowing. When traders want to bet on a price decline, they borrow shares and sell them, hoping to buy them back cheaper later. A scarcity of borrowable shares drives up the fees, making it expensive to be short. This massive share creation was, in effect, a relief valve designed to ease the immense pressure on short sellers who were being squeezed by rising prices and astronomical borrowing costs. However, this seemingly routine market mechanism was interpreted by many as an act of desperation. Just as the SLV announced this massive infusion of metal, a stunning declaration emerged from an executive at one of the world's most powerful financial institutions, JPMorgan. This high-level insider, Robert Goda, made a statement that sent shockwaves through the metals community. He claimed there was effectively no free-floating silver left in the market. This assertion implies that nearly all deliverable silver is already tied up in ETFs, industrial contracts, or other long-term commitments. According to this view, the metal injected into SLV was not sourced from an abundant, liquid market, but was likely scraped together from the last remaining institutional stockpiles. The timing was impeccable. one of the largest players in the silver game, essentially declared a physical shortage at the very moment the largest silver ETF was trying to reassure the market of its liquidity. This confluence of events, the record high prices, the intense physical demand, the pain of short sellers, the massive SLV share issuance, and the shocking admission from a JPMorgan executive, set the stage for the main event. The tipping point arrived at 3 in the morning, a time of minimal liquidity when global markets are at their quietest. It was then that the price plunged from over $53.50 to just over $50 in a mere moment. The critical detail, the one that points away from a natural market move and towards something far more deliberate, was the absence of volume. A normal sell-off, even a flash crash, involves a cascade of sell orders hitting the market. The charts from this event, however, showed a vertical price drop with no corresponding spike in trading activity. It looked less like a trade and more like a manual override, a reset. This was not the market speaking, this was an intervention. The lack of volume suggests that this was not a decision made by thousands of market participants, reacting to new information. Instead, it points to a concentrated, powerful force making a move, designed to have the maximum psychological impact with minimal financial footprint. By executing this maneuver in the pre-dawn hours, the actors involved could engineer a price drop without having to absorb a flood of buy orders that would have met such a move during active trading hours. It was a calculated strike, intended to break the market's bullish momentum and provide immediate relief to the beleaguered short positions. The event demonstrated that the paper price of silver could be detached from reality, if only for a moment, by those with the power and access to do so. This was the system showing its hand. The immediate aftermath of this ghostly price drop was as revealing as the event itself. While the initial shock was significant, the market's reaction was one of astounding resilience. The artificial smackdown, as it was quickly labeled, did not trigger a sustained panic sell-off. Instead, as trading volume returned with the opening of Asian and then European markets, buyers stepped in with force. The price did not languish at its new lows. It began a steady climb back, recovering a substantial portion of the losses within hours. By the time the New York market opened, silver was trading robustly near $52 an ounce. This powerful rebound sent a clear message. The underlying physical demand was so strong that it could absorb even the most blatant and aggressive attempts at price suppression. The intervention worked, but only for a few hours. This rapid recovery underscores a fundamental shift in the silver market. In previous years, such a dramatic overnight drop might have shattered investor confidence and triggered a prolonged downturn. However, the market of 2025 is different. Participants are now acutely aware of the deep structural deficit in the physical market. They understand that paper price manipulations are the death throes of a failing system, not a reflection of true value. The bounce back was not just speculative buying. It was a vote of no confidence in the paper price and a vote of confidence in physical silver. The event, intended to instill fear, instead hardened the resolve of those who believe the true price of silver is far higher than what is reflected on a futures screen. It exposed the paper market's vulnerability and, paradoxically, strengthened the case for holding the physical metal. One of the most critical indicators of the extreme stress in the silver market is a condition known as backwardation. In a normal, healthy market, the price for future delivery of a commodity is higher than the current spot price, a state called contango. This difference accounts for costs like storage, insurance, and the time value of money. Backwardation is the opposite and much rarer condition, where the spot price is higher than the futures price. It is a screaming signal from the market that immediate physical delivery is more valuable than a promise of future delivery. It means that users of the commodity are willing to pay a premium to have it now, indicating a severe shortage of readily available supply. The silver market has been flirting with and dipping into backwardation, a clear sign that the physical squeeze is real and intensifying. Further evidence of this unprecedented physical tightness can be seen in the soaring lease rates. A lease rate is essentially the interest rate paid to borrow physical silver. For decades, these rates have been exceptionally low, often less than 1%, reflecting an abundance of metal available for lending by bullion banks. However, in the current environment, lease rates have skyrocketed to astonishing levels, reportedly reaching 20 to 30%. These are not numbers seen in a normal market. They are figures associated with a market in crisis. It means that the large institutions that typically lend silver are either unable or unwilling to part with their physical holdings at any reasonable price. They are hoarding the metal, fully aware of its scarcity. This cessation of interbank lending, particularly by a key player like JPMorgan, has effectively seized up the gears of the physical settlement system. The collective impact of these phenomena, the price resilience, the backwardation, and the stratospheric lease rates, paints a clear picture of a market at a breaking point. The system that has governed precious metals pricing for half a century is unraveling. The paper tail has wagged the physical dog for so long, but the dog is now turning around. The artificial price drop was a desperate attempt to maintain control, but its fleeting success only served to highlight the futility of such measures against the overwhelming force of real-world supply and demand. The physical market is now in the driver's seat, and it is beginning to dictate terms. Every ounce of silver that is purchased and taken delivery of by an investor or an industrial user is another nail in the coffin of the fractional reserve paper pricing scheme. The key takeaway from this extraordinary episode is that the era of easy price suppression in the silver market is over. The levers that large financial institutions have pulled for decades to control the price are losing their effectiveness. While they can still engineer dramatic, short-lived price drops in the illiquid overnight markets, they can no longer control the narrative or the trend. The market's immediate and powerful recovery shows that the fundamental physical shortage is the dominant force. This event has peeled back the curtain, exposing the fragility of the paper-based pricing mechanism. It has demonstrated to a global audience that the price on their screen can be a manufactured illusion, fundamentally disconnected from the reality of the physical world. This loss of faith is perhaps the most significant consequence of all. Looking forward, we must prepare for a period of unprecedented volatility and, ultimately, a radical repricing of silver. The failed attempt to suppress the price will only embolden those who are betting on a physical shortage. We can expect to see an acceleration of demand for physical delivery from futures exchanges like the COMEX. As more contract holders stand for delivery, the already strained inventories will be depleted further, increasing the likelihood of a delivery default or a force majeure event. Such an event, where an exchange is unable to deliver the physical metal it has promised, would be the definitive end of the current pricing system. It would trigger a global panic, as holders of paper silver claims rush to convert them into a rapidly disappearing supply of real metal. In the wake of a potential COMEX default, the price of silver would likely bifurcate. We would see two distinct prices emerge: a paper price for futures contracts that settle in cash, which could plummet as faith evaporates, and a physical price for actual metal, which would skyrocket to levels that are difficult to comprehend today. The price would no longer be discovered on a screen in New York or London, but in the real world, based on what a willing buyer will pay a willing seller for an actual ounce of silver. This new price would be multiples of the current level, as the true scarcity of the metal, masked for decades by paper leverage, is finally revealed to the world. The inflation-adjusted high from 1980 of over $200 an ounce may no longer seem like a distant fantasy, but a conservative estimate. The implications of such a repricing extend far beyond the financial markets. Silver is not just an investment, it is a critical industrial commodity. It is essential for solar panels, electric vehicles, fifth-generation telecommunications, and countless other advanced technologies that are central to the future of the global economy. A sudden and dramatic increase in the price of physical silver would act as a severe shock to these industries. Manufacturing costs would soar, potentially delaying the green energy transition and slowing technological progress. Governments, recognizing silver as a strategic national security asset, may move to nationalize mines or restrict exports, further exacerbating the global supply crisis and leading to intense geopolitical conflict over this once abundant precious metal. The lesson from this recent event is clear. In a world of proliferating paper claims and financial abstraction, the ultimate value resides in tangible assets. The bizarre overnight price drop was a stress test for the silver market, and while the paper system showed deep cracks, the physical market proved its resilience and strength. It served as a final warning that the disconnect between the paper price and physical reality has grown too vast to be sustained. Investors and industrial users alike must now operate under the assumption that the paper markets for precious metals are not a reliable representation of their true value or availability. The game has changed, and the possession of physical metal is now the only guarantee of security. The future trajectory of the silver market will be defined by this ongoing battle between a crumbling paper regime and an ascendant physical reality. The recent injection of shares into the SLV was a significant tactical move, but it has not solved the underlying strategic problem of a market in a deep and persistent structural deficit. That injection of metal may provide a temporary supply of shares for short sellers, but it does not create more physical silver in a world that is consuming it at a faster rate than it can be mined. This act was akin to patching a dam that is about to burst. It may hold for a while, but the pressure continues to build relentlessly behind it. We must also reevaluate the role of major financial institutions like JPMorgan in this market. Their history is fraught with allegations and settlements related to precious metals manipulation. Their immense physical holdings and dominant position in the derivatives market give them an outsized ability to influence prices. The statement from one of their own executives declaring a lack of free-floating silver is a stunning development. It can be interpreted in two ways, either as a genuine warning about a market on the brink of a crisis, or as a sophisticated piece of market positioning, preparing the world for a scenario from which they are positioned to profit immensely. Either way, their actions and statements will be a focal point of the market going forward. The concept of a squeeze has become popular in recent years, but what is unfolding in the silver market is something far more profound and fundamental. This is not simply a group of retail traders trying to pressure a few hedge funds. This is a global, systemic squeeze driven by decades of price suppression, years of supply deficits, and an explosion in real-world demand. The short positions held by large banks are not merely speculative bets. They are integral to the functioning of the fractional reserve paper pricing system. If these positions are forced to cover in a market with no available physical metal, the entire structure could collapse with a speed that would shock even the most seasoned market observers. The psychological impact of silver holding steady above $50 cannot be overstated. For years, this level has represented a major barrier. Previous attempts to breach and hold it have been met with overwhelming selling pressure from the paper markets. The fact that silver has now established this level as a new foundation is a monumental shift. It signals to market participants worldwide that the old dynamics are no longer in play. Every day that silver remains above this price, the pressure on the existing financial infrastructure intensifies, and the inevitability of a major revaluation event becomes more apparent to all. It is also crucial to dismiss the outdated notion that the current silver price movement is primarily driven by inflation concerns. While inflation is a factor that supports all hard assets, the forces at play in the silver market are far more specific and acute. This is not a general flight to safety. It is a targeted run on a specific, physically scarce commodity whose price has been artificially suppressed for decades. The disruptions we are witnessing, the backwardation, the lease rates, the delivery shortages, are the symptoms of a market breaking down due to a fundamental supply and demand imbalance, a problem that cannot be solved by central bank monetary policy. As we look ahead, the path will not be a straight line up. The forces that have benefited from the suppressed price will not relinquish control without a fight. We should expect more attempts at smackdowns, more volatility, and more disinformation designed to shake the confidence of physical metal holders. They will use the full force of their financial power and media influence to try and maintain the status quo. However, the recent overnight event proves that these tactics now have a very limited shelf life. The market is no longer easily fooled, and the underlying physical reality is a force that cannot be indefinitely ignored or manipulated. The declaration from the JPMorgan executive that there is no free-floating silver left is a statement that should echo in the mind of every investor, industrial user, and policymaker. It signifies that the market has crossed a Rubicon. The days of treating silver as just another commodity are over. It is now a strategic asset of the highest order. The scramble to secure the remaining available physical supply will become the dominant theme in the months and years to come. This scramble will not be confined to financial speculators. It will involve nations and multinational corporations fighting for their economic survival. The ultimate lesson here is one of resilience and the enduring power of tangible value. The silver market, despite being subjected to one of the most direct and unusual interventions in recent memory, has held its ground. Its ability to absorb the shock and recover its losses in a matter of hours speaks volumes about the powerful undercurrents of physical demand that are now driving this market. This resilience is a preview of what is to come. As the paper structures continue to weaken and crack, the inherent value of physical silver will shine through with increasing brilliance. The coming normalization of the silver market will be a chaotic and disruptive process. It will not be a smooth transition, but a series of shocks and dislocations as the market violently rediscovers the true price of physical silver. This process will create immense wealth for those who are positioned correctly and cause catastrophic losses for those who are caught on the wrong side of the trade, particularly those who continue to place their faith in unbacked paper claims. The ghost in the machine that appeared in the pre-dawn hours was not just a glitch, it was a harbinger of this new reality. Therefore, the strategy for navigating this environment becomes remarkably simple, though not necessarily easy. The focus must shift away from trying to time the volatile swings of the paper market and toward the steady accumulation of the physical asset. The risk is no longer in the price volatility of silver, but in the counterparty risk of the paper instruments that claim to represent it. The strange events of the past few days have made it clear that in the endgame for the silver market, physical possession is not just an advantage, it is everything. The final price of silver in this new era is impossible to predict with certainty, but it will be determined by the immutable laws of supply and demand, not by the algorithms of high-frequency traders or the interventions of bullion banks. It will reflect silver's true role as both an essential industrial metal and a timeless monetary asset. The journey to that price will be fraught with peril and opportunity, but the direction of travel is no longer in doubt. The market has spoken, not in the noisy chaos of the trading day, but in the quiet, eerie calm of a 3 a.m. price drop that revealed more than years of analysis ever could. What we are witnessing is nothing less than the beginning of the great unraveling, the moment where the paper price of silver begins its long journey to reconnect with physical reality. The overnight event, the strange drop on no volume, was not the cause of this shift but a symptom of it. It was a brief, fleeting glimpse into the desperate measures being employed to hold back an unstoppable tide of physical demand. The resilience of the market in the face of this event is the most bullish signal one could imagine, confirming that the foundation of this new bull market is not built on speculation, but on the solid bedrock of a worldwide physical shortage. Ultimately, the story of silver is a timeless one. It is a story of value, scarcity, and the inevitable failure of artificial systems to suppress natural market forces. For decades, the silver market has been an anomaly, a place where financial engineering seemed to trump physical fundamentals. That era is now coming to a decisive and dramatic end. The strange events that occurred while we were asleep were the sounding of a bell, signaling that the final act of this long-running play has begun. The coming months will be a historic period of revaluation, and those who understand the significance of what just happened will be prepared for the profound changes that are now upon us. The future will be one where industrial consumers must bid aggressively for the metal they need to build the technologies of tomorrow, competing directly with investors who seek to preserve their wealth from the failings of the fiat currency system. This direct competition for a scarce physical good is what will drive the next phase of price discovery. The paper intermediaries who have stood between these two groups, profiting from the spread and controlling the price, will find their role increasingly irrelevant. The power is shifting from the exchanges to the holders of the metal, a transfer of power that will be permanent and irreversible.